yesterday, inflation is stuck above target with risks to the upside. In August 2022, with inflation raging, you gave a speech that echoed some of your predecessors as chair. You vowed to keep at it till we're confident the job is done. It's a vow you should fulfill. With this morning's confirmation that inflation is well above the 2% target at 3% and making move upwards, other economic indicators are positive. As you reported yesterday, a low inflation rate, solid GDP growth, and financial conditions continue to support expansion and investment. This is not a time to say that there are no risks, but some perhaps unseen. However, these risks in comparison to the risks of a resurgence of inflation present are modest. Given the already high prices due to President Biden's inflation, Americans simply cannot afford further price increases at the grocery store and gas pump. Such a resurgence would likely force the Fed to begin another tightening cycle, making mortgages, credit cards, and small business loans unattainable for many. That's why I urge the Fed to forge ahead with its monetary policy duties until you're confident the mission is complete and price stability has been restored. The fact is, over the past decade, we witnessed too many distracting additional mandates, diluting the Fed's core mission of price stability. This is the reason we formed the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity that will be led by Chair Frank Lucas. The task force purpose is to ensure that the monetary policy actions of the Fed are put under a magnifying glass and prioritized for this committee. And I look forward to our first hearing of the task force. I now want to turn to some of the other Fed responsibilities: bank regulation and supervision. The Fed was created by Congress to be an independent agency. The intent is to insulate the Federal Reserve's monetary policy from political influence. Unfortunately, in the last 2.5 years of the Biden administration, the Fed took on serious liberties with its independence in the areas of supervision. In law, Federal Vice Chair for Supervision is to develop policy recommendations that then are been brought to the Board of Governors for consideration. In my estimation, over the years, you and the board have been too deferential to the statutory Vice Chairman for Supervision. Vice Chair Barr turned the Basel III endgame rulemaking into a partisan attempt to propose a massive hike on capital on American banks, making them less competitive. The Fed has a chance right now to get back on the right track and preserve its independence for the long-term benefit of the American people. And with that, I yield back. Chair recognizes Mr. Lucas, the chair of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, for 1 minute.
Thank you, Mr. Chairman. While there are differences of approach in this room, a bipartisan guiding principle is that maximizing economic growth is the path to economic prosperity. It is the single greatest factor in delivering opportunity and improving the quality of life for the folks back home. The actions of the Federal Reserve and the machinery of monetary policy play an important role in economic stability. With the 5-year review of the monetary policy framework underway, I hope this will be an opportunity to evaluate the effectiveness of the Fed's toolkit and its vast influence on the lives of every American. The creation of the new monetary policy, Treasury Market Resilience, and Economic Prosperity Task Force will afford us the opportunity to dive deeper into this topic. Chairman Powell, thank you for being here. There are real issues that deserve our attention, and I hope today will be productive. I look forward to hearing your testimony on the state of the economy, where we're at, and where we're headed. Yield back, Mr. Chairman.
Gentleman yields back. The chair recognizes Mr. Vargas, the ranking member of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, for 1 minute.
Thank you very much, Mr. Chairman, and thank you, ranking member. And thank you, Chairman Powell, both for your years of public service and for appearing before our committee today. As a ranking member of the newly formed Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, I look forward to working with Chairman Lucas and the rest of my colleagues to address these important issues. The research is clear. Independent central banks perform better in carrying out their mandates than politically motivated central banks. The independence of the Federal Reserve is crucial to achievement of this dual mandate goals to maintain both maximum employment and stable prices. And although this dual mandate has been criticized by some, it continues to serve Americans well. It has not prevented the Fed from making substantial progress on driving down inflation, all the while avoiding a recession, which many saw as inevitable. I look forward to your testimony, Chairman Powell, and I yield back.
Gentleman yields back. I'd like to turn to the gentleman from Michigan and yield to him for a point of personal privilege. Mr. Heisinger.
Thank you, Chairman Hill. And as we all know, all good things must come to an end. And I want to take a minute to recognize someone who is leaving the committee, but has been an integral part of the oversight work Republicans have done over the last 5 years. Although Nicole Vo is all of 29 years old, something that we tease her about on a fairly regular basis. I quickly realized that despite her physical stature, she was a force to be reckoned with. Her dedication to my team, this committee, her colleagues, and this institution are something that we all should aspire to achieve. And Nicole has effectively served in various roles, from a professional staff member right out of law school to now Deputy General Counsel in this particular Congress. And her time with the committee, Nicole has worked on or led investigations into Sam Bankman-Fried, the bank collapses of 2023, terrorist financing, culture and corruption at the FDIC, and the SEC's climate disclosure rule, just to name a few. And I've sat through her questioning, and it's fierce and tenacious and directed. Myself, my team, and frankly, the whole Financial Services Committee team can't thank Nicole enough for her work and what she has done on behalf of this organization. And like all good staffers, she has become a confidant, a sounding board, has the ability to say no in a very nice way, but in a very tough way as well. And although Nicole will be leaving the committee, her contributions will not be forgotten and are deeply cherished. So thank you, Nicole. We deeply appreciate all your work, and I yield back.
Mr. Chairman, we welcome your testimony. Chairman Powell, you'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statement will be made part of the record. You're now recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and price stability for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. We are attentive to the risks on both sides of our mandate. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2000.
Mr. Chairman, can we ask you to pull your mic a little closer, please? Thank you so much.
Sure. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady since the middle of last year and at 4% in January remains low. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks to both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. This year, we're conducting our second periodic review of our monetary policy strategy, tools, and communications, the framework used to pursue our congressionally assigned goals. The focus of this review is on the FOMC's Statement on Longer Run Goals and Monetary Policy Strategy, which articulates the committee's approach to monetary policy, and on the committee's policy communications tools. The committee's 2% longer run inflation goal will be retained and will not be a focus of the review. Our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. We will take on board the lessons of the last 5 years and adapt our approach where appropriate to best serve the American people to whom we are accountable. We intend to wrap up the review by late summer. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve the dual mandate goals Congress set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you, and I look forward to our questions.
Thank you, Mr. Chairman. Chairman yields back. I want to recognize the ranking member of the full committee, Mrs. Waters from California, for a 4-minute opening statement.
Good morning, everyone. Welcome, Chair Powell, to our country is on the precipice of an economic disaster unlike anything we've seen in recent memory. While Trump promised lower prices for working class families, we're seeing the exact opposite. In fact, grocery prices are rising. According to the Labor Department, eggs are up 40% more expensive than they were even a year ago. In my home state of California, we've seen eggs as high as $9 and more for a dozen. Inflation is rising, and it is up to 3% for the first time since June. And other staples are about to get more expensive as Trump levies new taxes on steel and aluminum. America's consumers and businesses are facing uncertainty and chaos. This is all because Trump and his unelected billionaire co-president Elon Musk are taking a sledgehammer to our economy and democracy. In recent days, they attempted to illegally kill the Consumer Financial Protection Bureau, the same agency created after the financial crisis of 2008. Since its inception, CFPB has successfully fought on behalf of working class families against abusive big banks and predatory lenders, and not to mention returned $21 billion back to families who were swindled. Chair Powell, you explained yesterday that with the CFPB shutdown, there is no agency to supervise big banks to ensure they follow consumer finance law. In the face of these illegal, cruel, and relentless attacks, Chair Hill, it is both urgent and critical that you immediately convene a long overdue hearing with CFPB Acting Director Vaught, members of Congress, and importantly, the American public deserves answers as to why Musk and his Doge minions are in possession of sensitive consumer information and what they are doing with it. Additionally, Trump is simultaneously threatening import taxes on U.S. companies that will increase the cost of groceries and other basic supplies for all. Trump is freezing funds for housing assistance and community development and whittling down the federal workforce so that his billionaire boys club can suck any of these workers' salaries into their own pockets. This is all part of Trump's Project 25 playbook. You know what else he's taken from Project 2025, Chair Powell? Their plan to eliminate the Fed. We're watching this play out as Trump doubles down on his efforts to gut the independence of the Fed. As we've seen with demands that you drop rates immediately. In fact, his co-president Musk attacked Fed independence in a tweet earlier this year. Chair Powell, I know you have been adamant about the independence of the Fed and have thus far resisted pressure from Trump. But after your decision to eliminate DEI initiatives following Trump's illegal order, I'm concerned that Trump has more influence over you than you let on. I speak for all of my colleagues on the Democratic side when I say that you must stand firm in defending the Fed's independence. Reject any attempt by Elon Musk and his Doge minions to gain access to the Fed, its systems and data, and speak forcefully about what's at stake for our economy. The American public must hear from you, our central bank, today.
Gentlewoman, gentlewoman yields back. I yield myself 5 minutes for questions. Thank you again, Chairman Powell, for being with us. Let me start with the Fed's bank regulation and supervisory function. As I mentioned in my opening statement, over the past 2.5 years, the outgoing Vice Chair for Supervision has pushed new regulations that would move the United States towards a one-size-fits-all approach to prudential regulation that disregards the congressional mandate that's been quite clearly established for regulators to tailor bank regulation based on an institution's size, complexity, and risk profile. Earlier this year, the Fed board announced that Michael Barr would be stepping down from his position as vice chair on February 28th, 2025, or earlier, should a successor be confirmed. Significantly, the board also announced at that time that it does not intend to take up any major rulemakings until a vice chair for supervision successor is confirmed. I've discussed this with you. I've got concerns about that. You're not abdicating your supervisory response while we wait around for a vice chair for supervision. Do you agree that it's the Board of Governors that has the responsibility for bank supervision policy?
I do, and I would also agree that we need to carry on with our regulatory and supervisory duties. We can't take a holiday, and we will proceed with the things that we should be proceeding with.
You testified in the Senate yesterday, and know you enjoyed time with the senators, and you talked a little bit about Basel III Endgame. And again, in my opening statement, I talked about that the intent was to harmonize those rules, true for the largest institutions in the world, but also do that in a way that's capital neutral. And many of us here in Congress on both sides of the aisle felt like Vice Chairman Barr's approach was gold plating already high standards for American banks. You testified yesterday that you think bank capital levels are about right for those large institutions. Would you tell the committee today that it's your intent to repropose a Basel III endgame approach, just speaking on behalf of the Fed only, not the other supervisors, and that it be take into account the comments and that it be generally capital neutral?
We do intend to repropose Basel III Endgame, and we intend to do that just as soon as we can get together with the new leadership at the two other banking agencies. And as I mentioned, I think we can do that pretty promptly once those people are in place. I look forward to doing that. My long-held view, as I've said in many of these hearings, is that capital in the banking system for the largest banks is at about right. And that would be my starting point on going into these discussions. But I do want to defer. I do want to, leave it for my upcoming, new leadership at those agencies to have their own views on that.
I think that's important. I think it needs to be coordinated and harmonized among our supervisory agencies. And I do want you to take into account how Basel III endgame proposal interacts with other pending rules, whether they're on liquidity or the other things like operating risk in the companies. I think that was a lot of centrality of the comments that we saw on your bar proposal. Turning to monetary policy, looking back at 2020 and 2021, I was looking at all the principal monetary policy rules that you report in your semi-annual report. And had you followed any of the monetary policy rules that you track, they would have had you tighten sooner in the cycle rather than waiting. And I think that could have reflected, maybe not seen us have a 40-year high in inflation. Using the benefit of hindsight, do you think you should have looked at those rules more closely in the open market operations and tightened sooner?
I will say, and I've said before, that hindsight suggests that it would have been good if we had tightened earlier. I don't know how much difference that would have made, but I'd be very careful with those rules. Those rules, those rules in the middle of last year suggested that our policy rate was a couple hundred basis points too high. So we need to. They're a starting point, not an ending point.
Right. But we've had this conversation before. The point is that they do offer a roadmap, and you do mention them in writing in your monetary policy reports, except for one time during the pandemic. And I think, though, that you're adding that to your reference point and your forward guidance and in your communications, I think would be important. Can you tell us about the review of the inflation targeting and when you expect to complete that?
Expect to complete it by the late in the summer this year. We're just beginning it now, and we're going to look at all the decisions that we made, why we made them back in 2020. We're going to ask ourselves what's changed. We're going to be open to criticism and good ways of thinking about it, and I think we'll make appropriate, discrete adjustments.
I thank you for being with us today, and I turn to the ranking member of the full committee, Mrs. Waters, for 5 minutes for your questions.
Thank you very much, Mr. Chairman. It is no secret that President Trump, that he wants to do away with the Federal Reserve altogether. He said he knows interest rates much better than you do. I want you to know that some of us here have been fighting to make sure that everybody understands the importance of the central bank. Every country dealing with crypto, their central bank is involved. But of course, Trump and the opposite side of the aisle fought us. And that's one of the reasons we were not able to come together with a bipartisan agreement on stablecoins. You previously said that you would not resign if Trump asked you to do that. Do you stand by that commitment?
I have no changes to that.
I can't hear you.
Yes.
Thank you. Please let the record record that adequately. I appreciate that because you have a right to your position not to be interfered with by law, I believe, or even Constitution. When Musk comes knocking at the Fed's door, you gonna let him in?
I don't have anything for you on that.
Would you like to tell us today that you won't let Doge into the Federal Reserve or have access to the systems and the data?
So I don't have any, we've had no, no contact, and I don't really have, I have nothing for you to report today on that.
Well, you know what happened at Treasury, and you know what happened over at the CFPB, and the people of this country are being violated because all of our privacy is being taken up by Elon Musk and Trump, and we don't know what all they have on us, our bank accounts, everything that in our lives. So I want to protect it in the Fed. Mr. Powell, the last time you testified before this committee, you said, and I quote, "Really successful institutions in the United States generally are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table. That is the way we feel about it. And at the Fed, that is what we've been doing and will continue to do. Chair Powell, how will you ensure that the Fed continues to attract the best and most diverse employees?
You know, we're institutions like ours, private and public, are in a constant contest to hire the best talent in the country. And we've all learned, I think, and certainly we have, that we will go anywhere to find that talent, and including places that we didn't go 25 years ago. And we'll just continue to do that. You know, we're recruiting, as you know, at many, many, many universities and colleges, including historically Black universities and colleges, and others. And that's what we find, and that's our practice. We think that's the best way to go about it.
Thank you very much. And that's what I've always felt about the Fed. No matter what they call it, you only attracted and hired the best qualified people in your operation, no matter what they refer to it as, what they call it, whatever way they define it. Is that right?
Yes.
Thank you very much. Chair Powell, are you willing to provide my staff with an immediate briefing from your agency on the status of your OMWEs and equal employment offices?
Yes.
Thank you. I believe that you know that the OMWEs were created with the Dodd-Frank reforms. It's in law. And as I understand it, any attempt to dismantle OMWEs would have to come before the Congress of the United States of America. Is that your understanding?
Well, yes, Section 342 of Dodd-Frank, which is the OMWE section, is the law.
Thank you. Chair Powell, to what extent have you consulted with other board members in determining how your agency is complying with Section 342 of Dodd-Frank, and as well as any other federal anti-discrimination law?
I think we've consulted with senior staff and board members quite a bit.
Chair Powell, days after his inauguration, President Trump issued an executive order on digital assets, which includes a prohibition on central bank digital currencies, or CBDCs. The executive order banned any, quote, form of digital money or monetary value denominated in the national unit of account that is a direct liability of central bank, end quote. I'm concerned that this extremely broad definition could go far beyond CBDCs. Well, thank you very much. My time is up, but I appreciate your presence here today, and I appreciate your willingness to stand up for your right.
Gentlewoman's
to be the
time
chair.
has expired,
And
but
I now yield back. Thank you.
but I do invite the chairman to respond to the gentlewoman's question on CBDCs in writing. And now we turn to the vice chair of the full committee, Bill Heisinger, the gentleman from Michigan.
Thank you, Mr. Chairman, and Chair Powell, good to see you again. You had talked a little bit about your review. I'm going to start there. Obviously, a lot has changed in the last 5 years, pandemic, inflation, higher interest rates, name a few. However, I believe your dual mandate of maximum employment and stable prices should remain the ultimate objective. I assume you agree with that. I let the record reflect slight head nod on that, I guess. This committee is going to be very focused on monetary policy, and with my good friend from Oklahoma, Mr. Lucas, chairing a task force that I'm happy to be a part of. We're going to be addressing some of those issues. Chair Hill touched on some of the rules that have been discussed. I, for one, have always been particular to Taylor rule, but there's a number of rules. I know you go through those. At one point, I suggested that we could call it the Yellen rule with Chair Yellen. But there needed to be some sort of public declaration of what to benchmark against, and I still feel that that is of some importance. You outlined your timeline on this particular review, but I'm curious, do you believe that the last policy framework limited the Fed's response to raising inflation, something that you and I have talked about over the years?
No, I'll tell you why we didn't raise rates. We thought the inflation was transitory. I can show you forecasts from the end of 2021 by us, by staff, by the blue chip. Everybody thought it
Yep.
was going to be transitory. That's why we didn't raise rates.
And I also distinctly remember a hearing where you and Secretary Yellen at the time were sitting next to each other, and it looked like you visibly scooted away when I asked you both whether it was still transitory, and you had, for the first time ever, a separate answer. Her answer was yes, it still was transitory. You gave a very Fed speak answer of, we no longer believe the data shows that. So no. And we, to kind of go to Chair Hill's point, we think that might have been a little late on that. On back to the review, I'm curious, what sort of input are you looking for from the public and from Congress as you go into that review?
So from the public, we'll do a series of Fed Listens events, which were very successful the last time. And it involves us sitting down and meeting with people, some of whom know a lot about what the Fed does, some of whom just tell you what's going on in their communities. It was really, it was a very successful part of our outreach last time. In terms of Congress, we'll keep you informed of our progress. We welcome anything you may offer. But it's a public, we're open to the public on this. It's a public review as distinct from what we were doing before. And so we're welcoming views from all over.
And not to get ahead of the chairman, but I look forward to us having more conversations about that with the working group. I want to switch topics and focus a bit back to the bank supervision. Michael Barr has stepped down from his position as vice chair for supervision effective at the end of the month. And whether, frankly, President Trump fills that position is entirely up to him. But in the absence of a vice chair for supervision, you're still working, I think, on it. I think your quote to the chairman was, "There's no time for a holiday." Now, this vice chair of supervision is a Fed governor that has, frankly, extraordinary powers and responsibilities. And ultimately, my question to you is, does the Fed really need a separate vice chair to complete its work? Now, I got here after the 2010 election, 2011, shortly after Dodd-Frank was passed. I know this vice chair position was created by Dodd-Frank. I've just been dealing with the echo effects now for the last going on 15 years of Dodd-Frank. Do we really need to have a separate vice chair of supervision?
So for many years, as you know, we did our business without a vice chair for supervision. What that means is everything goes through the full board.
And it was effective?
I think it was, and also there was less volatility.
Explain that. Why was there less volatility?
Well, because you've got a group of 7 people on the board, and there will be some as appointments change. There'll be some changes in the approach to regulation, but putting it all in a single person, admittedly just to recommend to the board, can lead to sort of some volatility in these things, which is really
Larger swings in policy.
larger swings in the kind of things, and that's not great for the institutions that we want to regulate. We want to have a good set of regulation that doesn't swing back and forth very much. The question of whether it's a good thing to have in the law is really one for you. But I will tell you, we will once Vice Chair Barr completes his term in a few weeks, we will continue on until there's a new vice chair for supervision, and we can very much get our work done.
Or if there is one. So with that, Mr. Chairman, my time has expired.
I thank the vice chairman. Mr. Heisger yields back. Recognize the gentleman from California, Mr. Sherman, for 5 minutes of questions.
Chairman Powell, you are the only bipartisan person or thing left in Washington. You were appointed by Obama. Trump gave you a promotion. Biden reappointed you. And you are the only Biden appointee not to hear the words, "You're fired," from our president. So I hope we listen to what you have to say, because you're the only person that I can identify in Washington that has support on both sides of the aisle. Mr. Huizenga mentions the importance of your dual mandate. Project 2025 calls for abolishing the dual mandate and eliminating a mandate that you focus on employment. If we were to give you just one mandate dealing with price stability and take away the mandate on employment, over the next 10 years, would our GDP be higher or lower?
It wouldn't be possible for me to say.
Does the fact that you focus on employment as one of your dual mandates lead to lower unemployment, higher employment in our country?
It may do so. We do balance those things.
Thank
To some extent, that may be right.
Chair Hill spoke about how important it is that you maintain your independence. I noticed that in light of the hiring freeze, the Fed has removed all its job postings. I'm hoping that your personnel policy will be as independent as everything else at the Fed. But I'm more concerned with the president's statement at 7:58 this morning, where he said interest rates should be lowered. He said it. Will that influence what the Fed actually does?
I, as a practice, never comment on anything the president says, but I think people can be confident that we'll continue to keep our heads down, do our work, make our decisions based on what's happening in the economy, the outlook,
And
the balance of
statements
risks.
by elected
No
officials
change.
are not among the things that cause you to act one way or the other.
That's correct.
Thank you. And he went on to say, he said interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. I certainly agree with the rock and roll America, but the Peterson Institute says that the policies that the president ran on will raise the CPI by between 4 and 7.5 points. And I think the biggest element of that is the proposed tariffs. If we have higher tariffs across the board, say 10 to 25%, would that increase the cost of living? And would an increase in the CPI or related indexes of the cost of living lead to higher interest rates?
You know, there are many organizations, public and private, whose role is to speculate publicly about what this might be. What we're doing is we're reserving judgment until we actually know what the policies are.
But if we have a higher cost of living, does that lead to higher interest rates? The CPI goes up, or CPE, excuse me?
Well, if inflation goes up in general,
Yeah.
forget about tariffs. In general, of course, we will use our tools, which is the interest rate, to bring it back down to 2% over time.
Okay. Yesterday, you told the Senate we're going to release the stress test scenarios before we implement them. Will you take a holistic look at large bank capital requirements, including the risk-based capital ratios like Basel III Endgame stress testing, to make sure that you don't have a contraction in the ability of credit to Main Street businesses?
Yes.
There's a proposal in Project 2025 that we abolish Fannie and Freddie. If there was no explicit or implicit federal guarantee for those who invest in mortgages, would that lead to higher mortgage interest rates?
Since you'd no longer be borrowing on the credit of the United States, in other words, so Fannie and Freddie would be privately funded, it could lead to that. I think privatizing Freddie and Fannie might have other virtues too, though, as has been considered many times by this committee and others.
Might have some virtues, but it would lead to higher mortgage rates.
It could.
The CFPB has been put on ice, but all the regulations remain in force. So if you're a bank that wants to comply with those regulations, there's nobody that can give you any clarification. So you don't know. And if you're a bank that doesn't want to comply, the next presidential election may put into practice a CFPB that enforces all the regulations that the Trump administration has tried to eliminate. Does that cause confusion for banks?
You're speculating about what the situation might be. I would say that it could. Yeah.
I yield back.
Gentleman yields back. I now recognize myself for 5 minutes. Chair Powell, let's talk about the balance sheet. As we've discussed several times before, the consistent and massive growth of the federal debt creates long-run challenges for both the United States and saddles future generations with an onerous burden. But it also creates a challenging environment for the markets as the Treasury market expands in kind. As the Fed engages in quantitative tightening, allowing the Treasuries to roll off, the Fed is careful to ensure that there are ample reserves for the balance sheet. Could you briefly discuss the conditions that determine the ideal level of reserves?
Sure. So let me say that we intend to slow, and we have slowed, but then stop the process of shrinking our balance sheet at a time when we think that reserves are somewhat above the level that we judge to be consistent with our ample reserves framework. So what that means is we want reserves to be ample, meaning we don't want them to suddenly appear to be shortages of reserves. So we're going to think of where those shortages might appear, and we're going to put a buffer on top of that, because nothing good happens when there's not enough liquidity. So that's our overall framework. And right now we feel like all the evidence suggests that reserves are still abundant, which is more than ample.
As you know, in early 2021, the Fed stated that it would invite comments on the supplemental leverage ratio. That has not happened yet. I've made the point that the growth of the U.S. Treasury market paired with a decreased willingness of banks to act as intermediaries is a major issue on the horizon. When former Treasury Secretary Yellen was before this committee last year, I asked her about the resiliency of the Treasury market, specifically about the wisdom of permanently modifying the SLR. She said it's something that the banking regulator should consider. Does the Fed plan to finally look at the SLR?
Yes, I believe we will. I have, for a long time, like others, been somewhat concerned about the levels of liquidity in the Treasury market. The amount of Treasuries has grown much faster than the intermediation capacity has grown. And one obvious thing to do is to reduce the effective supplemental leverage ratio, the bindingness of it. So that's something I do expect we will return to and work on with our new colleagues at the other agencies and get done.
Because I think my colleagues are aware that over the course of recent times, literally we have 8 times as much debt to process, but only half as many major market makers. The Federal Reserve is not immune to politics. You, like every Fed governor, go through a lengthy confirmation process in the Senate. And of course, you're required to answer to Congress in hearings like this. I can trace a major political turning point at the Fed to the passage of Dodd-Frank, which greatly expanded the Fed's regulation and supervision authority. Chairman Powell, do you worry that the independence of the Federal Reserve's monetary policy function is in any way hindered by its role as a bank regulator? Can you do both?
Well, we can and we do, and we'll continue to do that. Clearly, the regulatory and supervisory side is more contentious in political circles, but we will continue to carry it out as best we can and to do so in a non-political way as best we can.
And clearly that'll be a major discussion topic in the task force. In my remaining time, could you discuss the Fed's 5-year review of monetary policy? What are the categories of issues you think that will be helpful to receive feedback on?
So a good part of it will be looking at the changes we made in 2020, which were made in an environment where we had been stuck at the effective lower bound at 0 for 7 years. And the highest we got our rate really was sustainably was 1.5%. And that was the highest of any advanced economy central bank. So the concern was that at the slightest downturn, we'd be back at the 0 lower bound and we'd be stuck. So we were looking for ways to make up for that. So then the question is, we got this inflation out of the pandemic and the events related to it. Are we in a different place now? And I think the chances are pretty good that maybe the effective lower bound is still a concern, but it's not the base case anymore. So we need to look at that and decide how what are the implications of that for our framework.
Thank you, Chairman, and I look forward to several more discussions on these topics. And with that, I yield back the balance of my time, and I recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, thank you for being here today. And you've indicated in past hearings that geopolitical tensions pose important risks to global economic activity. Back around this time last year when you appeared before the committee, you and I discussed how conflicts around the world, specifically the war in Ukraine, had impacted the cost of things like groceries in the United States of America. At that time, you indicated that the war had caused commodity prices to move sharply back home. Does that sound correct to you, if unfamiliar to you?
Yes, it does.
So just to reiterate, in this interconnected world that we live in, would it be safe to say that economic instability in other countries has the potential to impact economic factors here in the United States?
Sometimes, yes.
And so, given that fact, would it seem like a smart move for the United States government to remove one of our most effective strategic tools that, by mandate, assist U.S. commercial interests by supporting developing countries' economic growth and building countries' capacity to participate in the world trade? Would you agree with that?
It's not for me to be the judge or to say on that.
Well, we do know that a number of, like USAID, they buy a lot of their agricultural products, et cetera, from American farmers. And in fact, it helps the U.S. economy when you look at the volume of agricultural products that are being bought so that we can continue to be a part of the rest of the world. Would that be correct?
As far as I know, yes.
So, today we find ourselves facing a situation where the president and his Dodge buddy Elon Musk seem hell-bent on dismantling USAID, no matter the consequences, even if they are dire. To me, the assault on this congressionally authorized body represents an attack on the rule of law and should outrage every member of this body. Every member, Democrats and Republicans alike. And I know that your interest is squarely within your dual mandate and not foreign policy. I sit on both committees. I'm here, but I'm also the ranking member on the Foreign Policy Committee. And so I can't sit here today and pretend that what we're doing won't impact employment and economic stability right here in the United States of America. Weakening USAID will fuel global crises, endanger American security, embolden other nations like China and Russia, and leave us here in the Trump administration solely responsible for the fallout. So I have to take this opportunity to urge my colleagues on the other side of the aisle to also stand up for USAID. Anytime we travel, we go visit what they do. We go visit the good that they do. We go visit what their and how their economies improve so that they can be part of the global economy. So, if not because people just care about the rest of the world, then because we care about our country and recognize that instability elsewhere threatens our stability right here. It is extremely important in an interconnected world because the economy is interconnected around the world. We cannot isolate ourselves from the rest of the world. I thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. The chair recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. Chairman Powell, welcome. We're delighted to be here, and I hope that this comes with greetings from every single member that we appreciate and respect you taking the time, even though you're expected here. We think you show up, and we admire you. Mr. Chairman, you and I both know that way back when, and we assume 21, that there was a decision made by the Fed that gets close to quantitative easing and then the term tapering. And we know that it was sold as a monetary stimulus to help the country, and I get that. There was about, in my opinion, $2.33 trillion that were taken out in loans. And Chairman just spoke a minute ago about the term debt versus growth. Debt versus growth, about this amount of money that sits out there on the debt side. Could you please take a minute and discuss this issue and how we should be looking at it? Thank you.
Sorry, Mr. Sessions, are we talking about asset purchases that we made during the?
We are, we're
Okay,
talking about
okay.
when the Fed went and sold
QE.
treasuries,
No, we bought treasuries.
bought treasuries.
Yeah, we bought treasuries. So, it was a situation, I'll tell you why we did it. We were just out of the worst part of the pandemic, and we didn't know frankly, how good things were going to be, how strong the economy. We were very concerned. COVID is still raging, and it actually, had a very strong wave right into 22. But we wanted to we didn't want to stop buying treasuries too soon, because that has a stimulative effect on the economy, because we didn't want to provoke an unwanted tightening in financial conditions at a time when we thought the economy was still vulnerable. You look back in hindsight, we probably could have done that earlier and halted purchase earlier. In any case, we turned right around and started shrinking the balance sheet, and
You moved it from about 120 a month to 110.
but we're down now. We've been tapering for 2 years now, and we're down
That's correct.
more than $2 trillion. So, and we're still going. So that's why we did what we did.
Tell
and
me what that looks like in the longer term aggregate versus with what the chairman said, debt versus growth. Because we believe the debt remains and the growth is not equaling that
So-
ability to pay it back.
So what happens is we borrow money to cover the spending that Congress has done. Our purchases don't affect that. We're basically issuing reserves, which is cash, and we're retiring Treasury securities. And the effect of that is to drive down long-term rates. That's the whole reason for QE.
And what are you paying for those long-term rates?
Market rates. We're paying exactly the market.
And what would that market be approximately a year ago or to now?
Well, the 10-year, of course, we're going in the other direction now. We're shrinking now, but
We
were
are.
buying, the 10-year was yielding a very, very low yield on it. Was quite low during the pandemic, extremely low, because, growth was slow. There was a lot of demand for treasuries. So we were pushing down rates to support economic activity. When you can't lower your policy rate anymore and you want to do more stimulus, that's really the main thing you can do. It's actually the forefather of that was Milton Friedman, who came up with that thought way back.
$2 trillion?
Yes, we have.
Okay. And what do you believe remains, and you believe you're now stable for moving forward?
So I think we have a ways to go. Actually, the level of reserves, which is the thing we're focused on, hasn't really changed. All of that has come out of what's called the overnight reverse repo facility. I'd be happy to spend some time with you on this. This stuff is very complicated. And
Yes, I've
technical.
tried to find new data on it, and the last I found really was a CRS report of 22. So
It's
what's
very,
called
very big changes since then.
127, 22. And
Yeah.
so the changes that you speak of are important.
Yeah.
And so I would appreciate that time.
Be happy to do
Yes.
that.
Great. I want to thank you for being here. The confidence that the American people have that we will turn not just the economics of their lives, but of the country is very important. And I today spoke about the country. And I want to thank you for your service and time. Mr. Chairman, I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Chairman, and welcome, Chair Powell. Chair Powell, I'm worried about these tariffs. And I want you to kind of share with us your thoughts on these tariffs. I'm worried about, I think the president is wrong here. Tariffs can cause a terrible situation to the economy. I'm concerned about the inflationary impact on tariffs. And where cost increases from the tariffs, there's a cost to these tariffs. And we need not move into this area blindly. And some of these costs will be absorbed by business companies, but there are other costs that will be borne by the American consumers. We don't even understand this. And yet you have the president just using these tariffs as a means of fight or like a war. And this is going to do it. Everybody is not going to be Mexico or Canada. And while we got a little time, I want your thoughts on the dangers of these tariffs. The stock market is anticipating rate cuts. What will these tariffs do about that? Does the Fed see financial market stability as a factor in its decision-making process when considering the rate cuts? And here is specifically what I want you to get to. In light of the president, and politely I will say, his ill-crafted tariff strategy, do you foresee future rate cuts as a result of inflationary issues or due to a weaker labor market? And what do you consider to be promising inflation data? That's our big fight. And these tariffs are going to just add to inflation like a rocket ship. Your thoughts
So,
and share with us. Give us your opinion of the danger of these. There's a cost here. Tell us what you think about this.
the president has certain authorities over tariffs. Congress has authorities over tariffs. The Commerce Department is involved in some ways, but the Fed has no role in setting tariffs. And we don't comment on decisions made by those who do have that authority. We try to stick to our own knitting. In this particular case, it's possible that the economy would evolve in ways that, because of tariffs, or partly because of tariffs, that we would need to do something with our policy rate. But we can't know what that is until we actually know what policies are enacted. And remember, it's not just tariffs. There are significant changes to immigration policy, fiscal policy, and also regulatory policy. You put all four of those, and all four of those were things that the president was elected to do. We will then try to make an intelligent judgment about the overall effect on the economy of those, and conduct our policy accordingly. But it's not our role in any way to comment on the wisdom of the policies that are enacted by Congress or by the administration.
Will he have an effect on whether or not you will resume your plan to cut the interest rates this year or continue to hold?
So we'll make our decisions as we go about what to do with interest rates based on the data that we see, the outlook, the evolving outlook, and the balance of risks. And we'll be considering all of those things. We won't be focusing on any particular policy, and I can't tell you what we'll be doing, because it will really depend. It's fairly uncertain environment right now.
Yeah.
The underlying economy is very strong, but there's some uncertainty out there about new policies. We're just going to have to wait and see what the effects of those policies are before we think about what we can do.
Well, all I want to say, God bless you. I know your strength. We've worked together over the years on many things, and this nation is grateful that we have you, your wisdom and intellect at this time.
I agree,
So
but the
that-
gentleman's time has expired. Gentleman, get back. Chair now recognizes the gentlelady from Missouri, Ms. Wagner.
I thank the chair, and it's good to see you again, Chairman Powell. Chair Powell, under the Biden administration, American families were hit with a huge stealth tax from, as we've spoken about, inflation that drove up grocery prices and led to high rates on things like mortgages and car loans. Since 2021, the average Missouri household is paying about $1,100 more per month due to inflation. To put that number into perspective, the median family income in Missouri is $69,000. These families have had to spend $13,000 more of their annual income on the exact same goods. What specifically is the Federal Reserve's plan for making life easier for everyday Americans?
So the best thing we can do for Americans is to vigorously pursue both stable prices and maximum employment. We're trying to get back to a long expansion where prices are stable around 2%.
You seem to be there on labor, as you've pointed out, so tell me what else?
Sorry?
You seem to be there on labor, so
So,
what else?
I would say we're close but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now so that we can see.
We're definitely not there for 30-year mortgages, upwards of 7%, Chair Powell. So let me switch topics. I continue to believe that as we've spoken about, and as was brought up prior colleagues here, that the federal banking agencies, including the Federal Reserve, should scrap the flawed Basel III endgame proposal and start over. You talked a little bit about how you plan to perhaps do that, and a timeline potentially. But how will the public, Chair Powell, be able to provide comments on any revised proposal as required by the Administrative Procedures Act?
So I fully expect, and I think it's a good idea for the United States to finish Basel III in a way that's, in keeping with Basel and also with what other jurisdictions are doing, comparable jurisdictions.
The key
So
there is end game. This has
Sorry?
been going on for 2
Yeah.
decades.
Where's the end already, right? So, we'll put all of that out for comment again and welcome the comments for all commenters.
I should make sure we're following the Administrative Procedure Act.
Oh, yes,
As you move
we
forward.
will. We will.
Chair Powell, I understand you are interested in making the stress test scenarios that assess how a bank will perform through a crisis more transparent. As things stand now, while the Fed may make some information public, it doesn't show its math, which makes it difficult to assess the robustness and analytical rigor of the stress tests. Recently, the Federal Reserve announced that due to the, quote, evolving legal landscape, it would begin to take public comment on its stress test models and annual scenarios. Can you describe the changes in the legal landscape that have caused the Federal Reserve to suddenly seek public comment on its stress test regime and why it did not seek public comment from the beginning?
So we're an agency that's strongly committed to following the law as written by Congress and as interpreted by the Supreme Court. In the past few years, we've seen a string of administrative law cases from the Supreme Court, which are dealing with different issues, but there's a common theme, and that is significantly less deference to the views of agencies
Correct.
as compared to those of courts. Also, just a raised expectations for compliance with the Administrative Procedures Act. We take that very much to heart, and this is one of the things that we're doing because of that. And we feel the
You
appropriate.
can look at things like Chevron deference. You can look at the EPA ruling by the courts, and they are returning the power back to the people and the Congress, not the administrative state, not those agencies and rulemakers.
So because of those things, we are putting, as you went through it, we're putting the models and everything else out for comment and taking similar steps.
Well, I'm glad to see that. I understand the Fed intends to complete a comprehensive review of its monetary policy strategy, tools, and communications practices. You mentioned that. What is the timeline?
We expect to complete our work and announce the results by the end of the summer.
End of the summer. Thank you. I yield back.
Gentlelady yields back. The chair recognizes the gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chair Powell. Good to see you. Thank you for your good work. Chairman Powell, the Senate just filed a bill called the Genius Act. I'm always worried about anything that comes over from the Senate with the title genius in it. But but it is an attempt to provide a regulatory framework for cryptocurrency. And in that proposal, which is similar in some respects to the House proposal, it would allow individual states to oversee issuers. And there would be no central federal authority. The idea is to disperse the responsibility from state to state. My concern, my overriding concern is that with that spread of an expansion of crypto, and the president is 100% behind it. He just started his own meme coin. He's making a lot of money off of that, which is another issue. My concern is that the spread of an expansion of crypto will infect the traditional banking system because it's a volatile, speculative asset, and we've seen some very sudden disasters with crypto. I'm just wondering, are there any backstops that we can use, any firewalls that we can put in place that might insulate the traditional banking system, because they have access to the discount window and they're FDIC insured. So there may be, second order impacts if we have a collapse of a major crypto issuer. Are there any extra things that we can do to protect the traditional banking system?
Yes. So first, I would say there are really two things that are happening. One is banks are serving crypto customers, and we don't want to get in the way of banks serving perfectly legal customers as long as they understand the risks and that sort of thing. We don't want to single out any particular.
Are you speaking to custody?
Well, custody is more, the second thing is
Right.
undertaking activities
Okay.
on their own, right? And in that case, I do think it's appropriate to as usual, as bank supervisors, make sure that we understand and banks understand the risks that are involved in the activity that they're taking inside an insured depository. On the other hand, you don't want to go too far. I think there were a bunch of disasters, as we all remember, and we don't want to, and we were reacting to some extent to those. You don't want to go so far as to overplay your hand on that. So I think we need to be mindful that many of these activities can very well be done inside of banks, and custody may well be one of them. In fact, in Fed-regulated banks, there are lots of crypto activities happening now. They've just happened under a framework where we made sure that the bank understood and we understood exactly what they're doing.
Right. We also have the example of, Silicon Valley Bank and Signature Bank, First Republic Bank. One of the triggering events there. I mean, obviously the risk management was very poor in that respect, and they got on the wrong side of interest rates. But there were also some failures of issuers who had huge deposits at Silicon Valley, I believe, or Signature, or maybe both of them. And the suddenness of their collapse caused a run for the exits. And luckily, with a scramble, we were able to sort of save that situation so it didn't create a greater contagion. But are there steps that we can take that might strengthen our ability to respond to that type of collapse as well?
Yes. So in the wake of Silicon Valley Bank, we did work with many medium and sized banks that had any of the characteristics that we saw. And you mentioned, a long position in long-term securities that was underwater, along with a very unstable deposit base made up mostly of uninsured deposits. And in the case of Silicon Valley Bank, it was a lot of similar private equity and venture capital and hedge fund companies where they all just pulled their money out at the same time. So it was a bank run, and bank runs are very destructive whenever they happen. So we looked for that pattern. We worked with companies who had any aspect of that pattern, and we were successful, I think, in not having that crisis spread very broadly, and that was a good thing. Looking forward, though, we need to not forget that lesson and make sure that funding bases are stable, and that we're focused on the basics of of banking, which is credit risk, interest rate risk, liquidity risk.
Gentleman's time has expired.
Thank you. I yield back.
Gentleman yields back. Chair recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Chairman Powell, let me ask you a quick monetary policy question and then turn to bank regulation and treasury market structure. I know hindsight is 20/20, but it's important to learn from mistakes, as you know, and you've conceded that the Fed miscalculated on inflation and mischaracterized inflation as transitory in 2021, 2022 time period. Given that inflation remains stuck above the Fed's 2% target, will you commit to scrapping the flexible average inflation targeting framework? And if not, why wouldn't you commit to returning just to a simple 2% target?
So we're just we're just beginning the review. It'll be done, as I mentioned, by the end of the summer, and that's the exact question we'll be asking. I can't commit to a particular outcome. I need to respect the process and the views of the other 18 participants on the FOMC.
Yeah, I appreciate that. And I just hope that in that process that you and your colleagues recognize that that framework allowed rising inflation to persist and allowed the Fed to mislabel it as transitory. Let me turn to bank regulation. In October of last year, I led a bipartisan CODEL to Basel, Switzerland, met with the Basel Committee on Bank Supervision. And there, the committee actually conceded to us, agreed with me that the Michael Barr proposal of July 2023 actually gold-plated bank capital requirements. And instead of actually promoting international harmonization, actually made American banks less competitive. They conceded that to us. So I applaud the Fed for not moving forward on that July 2023 proposal that would have made it harder for large banks to, among other things, facilitate the smooth functioning of the U.S. Treasury market, including holding treasuries on the balance sheet. Couple questions. One is, should the goal of our bank capital rules, should it be regulatory harmonization internationally, or should it be American economic competitiveness?
I mean, clearly, the goal is to have a strong banking system that supports American economic activity and growth. That's the ultimate goal. What you get from Basel is a global floor so that the other banks can't run on less capital and sort of have a short-term advantage. That was the whole point of Basel, was to get everybody to the same kind of level so that it wouldn't be the race to the bottom.
And I see that utility, but I think the goal of our regulatory system should be America first, and it should be about American economic growth and competitiveness. But let's talk about the Treasury market issues. Obviously, we're issuing a ton of debt right now. In fact, according to BlackRock, we're issuing $573 billion of Treasury bonds every week. To put that in perspective, the entire national debt of Australia is $573 billion. So we're issuing Australia every week in this country, if you want to think of it that way. Would reducing excessive capital and liquidity requirements on U.S. banks for intermediating U.S. Treasury market take the heat off of U.S. capital markets and increase Treasury market liquidity and stability?
I strongly think it would help.
Well, I think that's especially an important comment in terms of your regulatory approach, because as you know, maturing bonds were being financed at an average of near zero during COVID, and now they're about double the cost of the average of about 3.5%. So now is not the time to make it more difficult for banks to hold treasuries. Let me just drill down with a little bit more detail on this Treasury market structure issue. Do you agree that the supplementary leverage ratio and the enhanced supplemental leverage ratio, the ESLR, are problematic as they create a disincentive for banks, especially large banks, broker-dealer affiliates, to serve as intermediators in the primary, secondary, and repo markets for U.S. Treasury securities?
I do.
And so you would commit to reviewing the SLR framework to create greater capacity for our banks to provide liquidity in the Treasury market?
I think it's time to move on the ESLR. And, we proposed doing so several years ago. We just didn't follow through on it. So I do think it's time.
Well, thank you for that. And finally, yesterday, during your appearance in front of the Senate Banking Committee, Senator Warren asked you about the future of consumer protection laws if the CFPB is abolished. Isn't it true, Chairman Powell, that prior to Dodd-Frank, consumer protection laws were implemented by financial institutions' primary prudential regulators?
Yes.
And so if there were a decision by the Congress and DOJ or whatever to repeal the CFPB, we could return the consumer protection law enforcement function to other financial regulators.
You could, yes.
Thank you. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, and would like to associate myself with the comments of the ranking member. And Mr. Powell, I would like to compliment you for standing up to the president, for literally preserving the independence of the Fed. It was one of those pivotal moments in time. It would have been more than your simply resigning. It would have been the president taking control of the Fed with one of his Pluto puppets. Mr. Powell, I'd like to speak to you now about the process of collecting tariffs. When the tariff is collected, at what point does that actually happen? If we impose a tariff, product is coming into the country, where is